Well, hello and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and I'm here today with Darin Davis, co-founder and principal of Club Capital and Presario Ventures. Darin has 20 plus years experience investing in real estate and is approaching 1 billion in successful executed transaction across all types of asset classes, starting in single family homes, condo conversions, storage facilities, retail centers, and multifamily housing. There's nothing this guy can't do. Excited to have you on the show today, Darin. Welcome.
There's nothing this guy can't do. This guy had a lot of lessons. Okay. So,
Well, yeah, that's how it is. After we fail a lot, then there's nothing we
oh,
can't do.
well, and it's funny when you were saying all that, I'm like, good God, I did do all that stuff. So I'm so glad that I landed and stuck with multifamily for the past 15 years. So yeah. So no, that's good. That's good.
Like all of us, we gotta cut our teeth and find our way, right?
Yeah, exactly. So I was going, oh God, those are some hard days 20 years ago. But anyway, we're
I,
here. Life is good. Very good.
this my favorite story to tell, Darin, is my mom and I bought an eightplex apartment building back in 2001, so 23 years ago. We still own it, by the way. And our mortgage payment, we bought it 100% financing from the seller, who was a little old lady whose husband had passed away. Our mortgage payment with taxes and insurance was 93% of the gross cash flow from the building. So there was no expense. There was no money for renovations. There was no money for management. So I was changing, poopy wax rings at 10 p.m. at night. I was resetting toilets. I was upside down, painting cabinets and ruining nice shirts because I would go after my day job to do those things. And it's just kind of the rite of passage. I think that the Lord, the universe, whatever, they say, okay, if you can get through this wall of crap, there's success on the other side. But I'm going to sit back and watch and see if you're going to make it or not.
That is so true. I mean, I tell people, I see so many people get this analysis paralysis. They educate and they never execute. And I'm just
Yep.
going, you know what? You're not going to hit 100% every time. You're going to trip. You're going to hit your knee. You're going to hit your nose. I mean, but until you do that, you're not going anywhere. I
That's
mean,
exactly right.
you're not going to learn it just from a book at all. Period. Yeah.
That's it. You got to change the poopy wax rings or some equivalent to changing poopy
Yeah.
wax rings to
Yeah.
get that. All right, Darin, give us a quick, background, a little about your journey from, investing in single family homes to what you're doing now with Club Capital and Presario.
Yeah, no, it's probably not a ton different, but there may be a little twist to it. I was living in San Francisco at the time and doing really good. This is pre-com, I mean, money was flying.
Yep. Lots of
I was
capital.
in paradise. My girlfriend then to be my future wife from Texas as well, where I'm from and located, but we were both out in San Francisco having a great time. And a series of things happened. And they happened like one right after another. And I was in my mid 30s and I said, wait a second, I got to step back and I'm not, something's not lining up here. And I was working, for a VC group and, I was Monday morning through Friday afternoon on an airplane. I was raising capital. I was making great money and I was spending the hell out of it on the weekends. But I remember that I just was not fulfilled. And I said, this is going to get really old really fast. But I had the drug, I had the income drug, I had the paycheck drug, and I was going like, this is gonna be tough. But I literally had a taxing event hit me under the Clinton administration with phantom income, which made me start going, wait a second, is this going to be my life paying taxes? The more money I make, the more taxes I was paying. And then I had my father had passed away, and then my grandfather had passed away, and I was going, I got to do something different, and I didn't know what different was. I just said it's got to be different. And you and I talked about this earlier, but I'm driving down the highway from San Francisco to San Jose, listening to AM radio. There was no podcast, no anything like that, but there was a guy on there talking about real estate, and I was just fascinated by it. And I remember pulling up into the parking lot of my office, and there was 15 minutes left on the show. And I sat in the parking lot and listened to the whole show. I said, who the hell is this guy? What's he talking about? I've never heard this. And it was Robert Kiyosaki, Rich Dad Poor Dad. And then, you couldn't go to the internet and just find a book. And this book had just come out.
Mm.
And I like literally I was calling the radio station. Who is this guy? Well, how did I get in touch with him? But that kind of set the pivot in place. And it didn't happen overnight, but I knew that I thought about it for 2 or 3 years, and I finally said, I've got to do something. And we decided to move from San Francisco back to Texas, where we're both from. And I told my wife, I said, you know what? I'm doing something different. And that started it. And where do I start? Single family home. That's where it started. And it started out with a Section 8 home, which I'll never do again either. So ever, yeah, ever. But that's where it all started. And you kind of asked about, how did you grow? I quickly learned that stubbing my toe, as we talked about earlier, on single family, did a storage unit, did retail centers, did land development, did spec homes. I mean, I just kept going, these are a lot of work, and they were all small deals. And then in 2007, we initiated our first multifamily deal.
Mm.
And then the big collapse happened in 2008. So I had to fight and fight and fight to figure out how to make that deal happen. And we got through it, and it was the best learning experience. And it literally catapulted me in my just education, having to go through 2008 and 9 on a multifamily development. And it literally, I learned more in 18 to 24 months than I probably could have learned in 7, 8, 9 years. And that's what started our multifamily practice. And we've been doing it ever since.
While others were sitting on the sideline in paralysis, analyzing things, you're learning lessons and figuring out. You're the man in the arena, right? You've got the blood and the dirt on your face, and you're learning faster than everybody else. I love that story. There's something else you said in there that I just want to hover on for a minute. If you ask most people how much money they made last year, 99% of them could give you a pretty accurate ballpark. If you ask somebody, how much did your net worth go up last year, or what percentage increase did your net worth go up, 1% might be able to tell you, because people watch the lead indicator, which is income, versus the lag indicator, which is how they're progressing in terms of the growth of their cash flow or the growth of their net worth. And people are focused on the wrong indicator. That at the end of the day, when you retire, or when you want to take a step back and do something else and leave a full-time job, it is not going to matter to you one bit how many dollars you made in 2024. It's only going to matter how much you increased your cash flow or how much you increased your net worth that year. So you hit on a really important point there, that it sounded like to me, you realized, hey, I'm chasing the dollar. Kiyosaki's teaching me I need to escape the rat race. Those are two very different things. So that was a great lesson I just wanted to highlight.
Yeah, and I got to tell you, and I live by this more so in the last 10 years than I did any other time. But I look at income as transactional, and wealth is foundational. Okay. And I get so many young people chasing these unicorn returns, and I'm going, guys, I go, you may hit the one, okay, but you're going to lose on 2 or 3. And then the one doesn't matter. I said, but if you build that foundation, and you build that net worth, and you start building those things today, you're going to look up 10 years from now and go, whoa.
That's right.
I didn't realize what I did 10 years ago is now so foundational that it can't just go away tomorrow.
So
and so it's so hard for younger people in their 20s and 30s to grasp that concept. But if there's any just nugget of information in this first 10, 15 minutes, it's really look at relationships, foundational wealth building, growing your net worth, because that will matter 10, 15 years from now.
And get on base. See, I remember distinctly as in those younger years looking around and going, wow, everybody looks wealthier than me. I have to hit a home run to catch them. And what I realized over 25 years now of investing in real estate is those base hits are home runs when you look back at them 20 years later, because the mortgages are paid off, the rents have tripled, and they're all home runs. It just took you 20 years for it to show up as a home run. The important thing is you just get on base and you didn't lose your capital swinging for the fences for some outlandish high risk investment.
Well, that's the foundational stuff. And, and it's really hard. I look back and even we've sold some assets in the last 10 years that I wish I had kept, and I was going like, but I had partners in the deal. So I didn't control the final decision. Yeah. But hindsight, those partners had come back to me and said, God, I wish we had kept that. I'm going, I know, I wish we had kept that. Don't be so excited to sell. It's really hard to replicate a good deal over and over again. So
here's the problem with selling. You sell the piece of real estate for dollars. And the problem is the piece of real estate continues to go up in value and your dollars continue to go down in dollars. So that's the problem with selling. Great. What am I going to do with the dollars? I mean, unless you need it to survive this month, leave it invested. Yeah. Wait for rates to go down, pull out some money that you can pay with higher rents and use that to go buy something else.
Yeah, that whole refi concept, holding that asset long term, that's just brilliance. That's just magic. So
and you don't really know it until you're 10 years down the road or 2 decades down the road. So it takes time to turn those base hits into home runs. Darin, I want to talk a little bit about the cycle that we're at. I was talking to a good buddy of mine who's also a realtor the other day, and he said to me, how come buyers don't buy in buyer markets? And a buyer market, for anybody who doesn't know, is when there's the sellers are more amenable to negotiate. There's less demand. So the seller will come down in price. They'll give you more time for due diligence. They'll pay your concessions and closing costs, all those types of things. What tends to happen is in a seller's market, right? When there's 20 buyers lined up to get into the open house, when there's 5 offers on the home, when they're in a bidding war, then buyers feel real secure. They feel really safe. Well, everybody else is doing this, so I feel safe being a buyer as well. You don't want to be a buyer in a seller's market. You want to be a buyer in a buyer's market. But paradoxically, buyers are fearful in buyers' markets. So I think that plays into a little bit of the cycle of where we are in the real estate investment but just the real estate market in general. And I'd love you to comment on that. And I can bring up the really incredible slide that you put together if you'd like me to.
No, yeah. I mean, you can pull it up right now, or I'll do it in a second as I'm talking about this. But, historically, retail investors, and that's you and me for the most part, and all the people we hang out with and that we talk to, we let too much emotion drive our decisions. And I always tell my kids, I go, kids, and my kids are starting to repeat it back to me now. So, but I go, kids, I don't think I've ever made a good decision based on emotion. I said, I can't think of one. And I really put that into them because, just a lot of things going on with kids, and they can be emotional until they're mentally and emotionally mature. But if you look at the institutional guys, and we're in this side, this is why I want to talk to you guys about this, because we're at this point right now where I think there's some really big opportunities, but the emotions have to be taken out of it. And you've got to look what the institutional guys are doing, they're data driven. Okay. They don't give a rat's anything about anything other than the numbers. So, what you're showing here is what anybody that's, 40 years of age or older experienced firsthand, because you're a young adult here. But, we had the great market collapse of 2008 and 9. Mm-hmm. And if you look prior to that, and I clearly remember, I just started my real estate career, so to speak, back in 2002, 2003. So from 2002 to 2007, I thought I was the smartest guy in the world. Well, so did everybody else,
right here.
Yeah, until we learned. Yeah, and then we hit the subprime mortgage. Now that little video thing that you see in the top right, I tried to stick a video clip in there from the Big Short.
Oh yeah.
And when it's like boom, Yeah. And so when that happened, people start getting super emotional. And, you see on there, I have denial, and then Bear Stearns collapses, and then people start panicking. We all did this, okay?
Yep.
And the market hits the lowest point, and nobody knows what to do. Well, the good point here, the thing that started happening is that retail buyers did not start coming back into the market until about 2014
Yep.
ish.
Yep.
Okay. Well, guess when the institutional money started coming back in? Right around 2012, 2011, right? Even earlier, 2010 is really when they started. But when you see the institutional money, they said, man, we've hit the low. We may not even be at the very bottom, but we're somewhere in that low spot. The retail guys are still out in left field because they're still scared to death. And when the market started recovering, anybody that was active from 2010 to 16 just were hitting home runs. I mean,
Yeah.
absolute home runs. So, that is and we're in a similar situation where we are today. Okay. So if you go to that next slide, we can do an overlay from 2007 to
Oh, great.
2021 to 24. If you look to the left, we hit the high there in 2021 ish, somewhere in that time frame. And in the end of 21, we started having rate increases. I mean, people talk about rate increases, and then we have a supply demand issue, too much supply. Then we have leverage issues. We have the banks aren't willing to do this, and now same thing starts happening. Market starts cratering. The perfect storm of all this stuff had happened. Not near as bad as 2007 or 8. Fundamentals banking wise are much better now than they were then. But we have the same thing we've seen over the last 18 months. The retail guys are just scared to death, and they're selling, and they're getting out, and they're not reinvesting. And if you look at the institutional guys, about 2 or 3 months ago, they started coming back into the market, and not in a small way, but in a big way. I mean, KKR bought a $2 billion portfolio. Goldman Sachs, same thing. All of the big guys, JP Morgan Chase and CB Richard Ellis are saying we're at the bottom. We're there. We don't know where at the bottom, but we're not going to be at the bottom much longer. So what I would say to people that are not on the institutional side, watch the institutional guys. They're starting to come back in. We have had 3 properties in the last 4 months now that have gotten multiple offers on them. Multiple, not 5, but like high teens. All right. And what that's telling me is a year ago, those same properties may have gotten 2 or 3 lowballs.
Yep.
But they're getting family offices and institutional money coming back in. And this tells me that the numbers and the data and the institutional guys realize we're in the bottom. Now let's catch that wave back up. So if you missed it in 2010 to 14, don't miss this one.
Great context. And I'm just going to overlay a residential context for everybody who's not playing in the commercial space yet. If you look at the transaction volume in residential real estate over the last year, it was some of the lowest transactional volume that we've seen in decades. There's an estimate that somewhere between 30 and 50% of mortgage professionals have left the industry. Full-time realtors are down somewhere around 20%. So these are people who've left the real estate industry. I'm talking residential, because of this low amount of transactional volume that has happened over the last couple of years. And of course, that's because inflation pushed up mortgage rates, made housing less affordable. So even though prices have stayed relatively high, you've seen the transaction volume go way, 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 way down. Now, the shift that's happening is you're seeing mortgage rates that peaked near 8%, now down around, the low to mid 6% range, and continuing to go lower. Mortgage rates are set based on the future expectation of inflation, and the future expectation of inflation is going down because if you're looking at the jobs reports, there's a lot less job openings. There's a lot less new jobs. We just got a new job report this morning. The unemployment rate, quote unquote, went down 0.3% or 0.1%. But if you look at the jobs, we lost over 400,000 full-time jobs and replaced it with 500,000 part-time jobs. So you're seeing a slowing down in the economy. That's less inflation. That's less lower mortgage rates. That's going to bring greater affordability. So there's this moment in the residential world right now where the sellers have had a lot less interest from buyers. Mortgage rates are down and the numbers are starting to work, but people are emotionally fearful of what's going on. So this is a great analysis between what's going on in the commercial world where the institutional money is coming back in because they can sense the bottom, but the retail investor, the retail even home buyer is still, is still fearful and not wanting to get in on this buyer's market.
Well, I'll tell you something I saw yesterday on the retail side as a home purchaser. I'm kind of, I'm an empty nester now. And so I have this house that I don't need. I've got way too much house. So I said, you know what, I'm going to poke around on some condos downtown Austin. And I had looked at those 4 or 5 years ago and prices were, $1,000 a foot, $1,200 a foot. I mean, this is nuts, but the first one I hit on in a nice building, only a 4-year-old building, was down 30% in price. Okay. And the seller said potentially owner financing and help with your buy down on your mortgage. And I'm going, that is where you need to go strike right now. Okay. There's still some softness over there, but if you understand where we are in this market, retail and commercial, we're somewhere in the bottom. I mean, you're not going to see those deals a year or two from now. You're going to see them now. So
you have to ask yourself, what's going to happen to the real estate market when rates hit 5%? And if you look at every recession, which it looks like we are headed towards one based on the increase in the unemployment numbers and the less number of full-time jobs being created, if you look at gross domestic income, which is way down, you have all the signals point to a global slowdown. Germany's slowing down, China's slowing down, Japan's slowing down. In recessions, mortgage rates go down always, 100% of the time. So if you follow that logic and mortgage rates are headed down in the 5% range and you ask yourself, what's going to happen to this market? Well, of course, there's a certain place where people are going to come off the sidelines and back into the market. You want to beat them to that point. You want to get into that market before there's a line of buyers at the door, because then the seller's not going to be as amenable. As you said, they're not going to pay your buy down. They're not going to give you concessions. So This is great. I think this has been super helpful. So out of curiosity, do you think you're going to buy something, a condo, or are you still just playing around with the idea?
I've still got 2 dogs, so
Okay.
And they're big, so I can't really do a whole lot. But you know what? It was priced at a point where I'm sitting there going, my God, I could, if we had a more friendly environment for VRBOs or Airbnbs, it could take, I'd be fine with it, but I'm seriously going to go take a look at it, because if he's going to do owner financing and do a buy down, I'm not going to find that in 2 or 3 years from now. And 2 or 3 years from now, I'm more likely to be in a downtown condo than I am out on 8 acres in the country. So, yeah.
Exactly. All right. Well, keep us posted. I want to know about that.
I will. I'll let you know what happens on that one.
So let's talk a little bit about the rule of 3 and how investors can harness the power of patterns. You talked about that. I'd love to share that thinking with our listeners.
Yeah. I think that I know where this started. When I was young, we didn't know what dyslexia was. Okay. So I always tried to figure out where I performed at my best. Okay. When it became math or reading or anything, being able to remember to do stuff. And I didn't really realize that until about 10 years ago, but I'm going to back up and share one little side note with you. Um, Everybody on here probably knows the Beatles, right? We all know the boys. Um, 21 of their number one hits were done with three chords. Okay,
Really?
21 with three chords. All right. Uh, what happens on there is and it's been scientifically proven that you can execute, remember, and do things in threes
Yep.
than in fours and fives and sixes. And
Absolutely.
everybody tries to make it so complicated, and it's not. It's 1, 2, 3, lather, rinse, repeat. 1, 2, 3. And if you can get your focus into three things that you can execute on, no more, okay? Because let me just do this or do this. You start losing your sense and your ways and just everything.
Mm.
Again, I work on my kids are my test studies on most all this stuff, as I start working on it. But I've got them doing stuff in threes. I say, guys, what were the three things today, the three things this week, and the three things for the month? And they can remember that all day, every day, and they get it done. So my thing is to young investors or young people buying their first investment property is it's not complicated. Just pick the three things and execute. 1, 2, 3, execute.
So let's bring that all the way down to the ground level. If you've got a newer investor, let's say they own a house, maybe they have their first investment property, but they're very young in this journey. Give me an example of what would be the three things that you would have them focus on.
Well, if it kind of depends if it's an acquisition or if it's a business model. Okay.
Uh-huh. Okay.
Yeah. So, if it's a business model, what are the three things? And a business model means, what's the process you're going to go through to buy a house? That's
Mhm.
your first business model. Okay.
Mhm.
Well, you're gonna look for your debt sources. Okay. Your debt
Mhm.
and equity. That's going to be one. You're going to look for your supply demand. Okay. It's going to be two. And then you're going to look at your demographics. Okay. And if you stick to those three things and understanding that the demographics in that area, that supply demand for that street corner and the debt and equity, don't go outside of that and try to paint these crazy pictures because nothing's going to be perfect. Okay. Nothing is going to be perfect, but write those three things down and stick with them. All right. Don't let scope creep. And that's what we used to call, I don't even know if they still, that's back in my software days. We used the word scope creep. I don't even know if
Yeah.
that's
Yeah.
used
That makes
anymore.
sense.
Oh, is it still
Yeah.
a thing? Okay. So, but that was back in the 90s. Yeah. But just stay so laser focused. And when it works, do it again. And when it works, do it again. So many people get, oh, well, that worked. I want to try something bigger and better. And not that you can't try something bigger and better, but the execution worked. Take that execution and go bigger and better. Don't change your whole model the whole time. And I was so guilty of that, and I learned. But keep it simple.
It really makes a lot of sense. And it ties back to how we opened that the institutional guys make decisions on data, not emotion. So then
Mm.
if you tie these two concepts together, all right, what's the financing that you can get right now? Is it getting, is it headed in the direction where things are getting better or things are getting worse? Right now, mortgage rates are headed down. So that is getting better. What is the demand versus supply of homes in the area that you're looking at, and then what are the demographics? Are people moving into the area? Are people moving out of the area? Are there jobs being created? Are there jobs being lost? But you can kind of, if you can narrow it down to what is your search criteria that would tell you, not emotionally, but analytically from an analysis standpoint, okay, this is the deal. I can make the payment. The mortgage rate's going to be fixed. I can see that there's people moving in. There's jobs being created in this area. This is it. This is the analysis I need to pull the trigger to move forward on this deal.
Well, and the thing, and you say it perfectly, Josh, that, I mean, you can always say, well, what, one more, one more, one more. At some point, you've got to make the decision with the best data you have and execute. Are you
Yeah.
going to hit a home run every time? No, but are you going to hit a home run by a learning lesson? Absolutely. You may only make a single or a double, or you may break even, But I tell you, and my wife, my late wife, every time I would have something that I was saying, we're doing it, she would say, well, what about this? What about this? What about this? And we would never do it. And I finally just said, you know what? I don't think us working together is a greatest thing ever to do. I said, she goes, okay, then you go do your thing. And it was, because she was the type of person that would say, well, if we wait just one more month, maybe the price will come down. Or if we add this, or maybe the price will go up. Or if we do these three things, and I'm going like, it never ends. It
Yeah.
never ends. Yeah, and so that's the 1, 2, 3. Yeah, just keeping it simple.
It's a great lesson. It reminds me, Warren Buffett has in one of his shareholder letters, he says, I try to keep these analysis simple, where I write down when I'm looking at an investment, or I'm looking at buying a company, or I'm looking at investing in a company. I'll take a piece of paper and I write down what are all of the headwinds, meaning all of the forces that are pushing back against this, giving resistance against this investment having success, and then what are all the tailwinds, and what are all the things that are propelling this investment forward. And if I have more tailwinds than I have headwinds, I do the deal. And it's just a really interesting way to get all of your doubt out on a piece of paper and say, which is going to win here, the headwinds or the tailwinds? And then you can make a rational decision versus an emotional decision.
I like that. I'm going to use that with my kids. I'm going to test that on them. But here's the thing: don't get in your own way. Okay, you could be your headwind. All
Oh,
right,
that's a great
you got to exit
analogy.
yourself out of it. And you got to use data and not you. So
Great point. Yeah, emotion could creep in there. You got to keep it data driven. Great
yeah,
point. Well, hey, we talked a little bit about, my opinion that the economy is slowing. In fact, actually, I was talking just a little bit about the jobs numbers. This is so important because, the telling sign of an economy contracting or expanding, it rests on many times job growth or job contraction. And this was a graphic that just came up this morning, from a subscription that I use, MBS Highway. And so, the headline number, unemployment rate went down from 4.3 to 4.2. But if you look under the hood, 527,000 part-time jobs were formed, 438,000 full-time jobs were lost. And they revised the June and July numbers down 86,000 jobs. So it's interesting. It seems to me that things are slowing down, but I'm curious on your perspective. Where do you think we are in that cycle of a potential recession, and how does that impact your thesis on real estate investments?
yeah. I live somewhat in a bubble. All right, being here in Austin, and there's several bubbles around the country. Yeah, so I understand it from a macro, what's going on, and I can tell you this. I remember meeting with our mayor here in Austin at the time, Mayor Wynn, and it's 25 years ago. But as I came out of his office, he had up on the wall as you exit the door, nothing matters except jobs, jobs, jobs. And I
What a
go,
great mayor.
no. And I just said, you know what, that is so true. And so you're right, jobs, but here's where I think we are. I think there is going to be a slowing. I don't think the election, if the Republicans get in, I still think it's going to be slow. I don't think there's going to be this euphoria. We flip a switch and we have MAGA mania going on that. If the Democrats get elected, at the end of the day, I'm kind of like, it's not going to change that much from what we do in day-to-day basis. I think what we focus on is my bubble. Okay. Because everybody has a micro, environment that they live and work in. And my life here, in Austin, Texas, in my investing is far different than probably 70% of the people that will hear this. It's just different everything.
Yeah.
So I don't know that I would have this, magic answer to the question, what's going to happen. But what do I think? I think I stay real local. I think I stay real focused. I build my relationships and I conduct business in my world. And I don't worry about all that other stuff that's out there, because at the end of the day, what's happened at the federal level, and this, is not near as impactful as what's happened at the state or the local level.
It's a great answer. And that goes back to your kind of initial premise, which is take emotion out of it, focus on what you can control and what you know, and make decisions on those things, not things that are out of your control. So I think that's actually a great answer, Darin. So you've invested across a lot of different assets inside of real estate, right? Single family, condo conversions, and you mentioned earlier in the show that I think you've come to decide that multifamily, meaning apartment units, are kind of your jam. That's the thing you like the most. Did I get that right? And if so, why is that? How did you get to that conclusion?
Yeah, no, you got it right. And I had to turn a lot of stones to figure that out because I was afraid to go big. I mean, wow, a $40 million apartment complex. I will never be a $40 million apartment complex guy. I'm going to be the $3 million self-storage, or I'm going to be, something, and I questioned myself. But then I had a friend come to me and just said, man, you work a lot for a little. I said, well, I'm learning. Okay. And he said, well, have you ever looked at doing this? And this was doing a subdivision development of land. Well, that was in, where we break up the lots and sell them because, and that's when the market collapsed in 2008. Okay. So I was not really still thinking I was a multifamily guy. Well, I made a careless mistake, which almost cost me everything. I bought the land without having it fully entitled, and then the market collapsed. I got my term sheet rejected. The guy said, "Hey, we're going out of business. I don't care. You're not going to have any money from us." But it forced me to find a solution, right? And what this friend said, he said, look, the only people lending money right now is the government. So have you ever heard of a 221(d)(4) loan? And all it is a loan insured by the government for new construction of apartment units. So I said, no, I've never heard of it. Well, I got introduced to that. And over the course of about 9 to 10 months, I was able to secure a construction loan with insured by, and by the way, the only people that were lending at the time were lenders that had the government insuring their loan.
Sure.
So yeah, and we went and did that. I worked with the city of Austin, and we worked out a deal with them where we would provide some affordable housing. They had some bond money that was not being utilized because the market had stopped. So it was bond money for housing. So we secured some bond money. We got the HUD loan, and we were able to build a 240 unit apartment complex in 2009 and 10. And boy, when we started coming out of our recession in 2011, my rents started tripling. I was the only guy in town that had new products out. And I said, you know what, as hard as this was, I learned a ton of lessons. But the main thing I took from that is that whether I was doing a $5 million or $40 million project, it was the same amount of time, the same amount of energy, effort, everything. And I said, the government likes to fund. This is what got me. The government likes housing. They like loaning on housing, and your banks like the leverage on it. And I said, this is the easiest, hardest thing I've ever done. Meaning that they are trying to give me money. The reason it was hard is I'd never done it before, but they want to loan me money. They want to provide housing. The city, almost $3 million in bond money. So it just, I could see that, wait a second, there's something here. And I started putting the pieces together, and I figured out what the puzzle really was. And I said, it's housing, and it's affordable housing, and it's housing. So that's what launched me into multifamily. And that was 2009, 10, and haven't done anything different since. So
It's great. It's great. I had a podcast guest that I was on with that was a real fan of I think storage units was his jam, but he'd done a lot of different asset classes. He'd done big box retail, all kinds of commercial stuff, and he said, what I love about the storage unit business, and the same thing would be true to the apartment business, which is why I'm telling this story, is because you have granular cash flow. And I said, well, what the heck is granular cash flow? I never thought of it that way. He says, well, if you own a mall and Dillard's or Nordstrom or Walmart is your tenant, because most of those buildings they don't own, they just lease from somebody, and you lose one of those, that is a huge block of income you've lost. But in storage units or apartment buildings, it's granular cash flow. In other words, there you lose one, there's 239 others in your analogy that are still carrying the rent on that building. So I like that a lot as well. I love the granular cash flow of apartments. The challenge I've had recently, Darin, is that I'd say maybe this is over the last, say at least the last 7 years, is that that it's become such a popular asset class that the prices that these things sell at versus the cash flow you can generate, the prices just seem out of reach. So how are you dealing with that? How are you finding apartment buildings that cash flow? Are you still building them from the ground up? What are you doing?
Yeah, that's a great question, and I'll tell you this: that we have somewhat of a tainted expectations, okay? Because prior to 2008 or nine, real estate was, you were looking at IRRs, meaning returns on just money you were making on your money. If y'all don't use IRRs in single family, but if you're making 6, 7, 8%, that was an acceptable return pre 2009, 10. Okay. And people wanted just that solid foundation, consistent real estate, and then for people that were the owners of the asset or the sponsors, there was just some, better leverage, and there was some depreciation and all that. Okay. Well, now we have this tainted expectation because from 2000, let's say 11 to 21, people were seeing IRRs and returns that were 2x of that, 2.5, 3x of that, which was just not normal. And we didn't have money that cheap. I don't, that in our known, I mean, for the last 80, 90 years that we can probably look back and see, but that was a 10-year, 10-year period where money was free. And I think that really, put in people's minds that this was normal. Well, now we're coming out of this second, dip here. And I think every limited partner investor, every investor needs to understand that the expectations should not be in the 17 to 23% IRRs. They need to be in the 13 to 16%, the 12 to 14, if you still want real estate to be part of your portfolio. There's going to be those unicorns out there for sure. We may see a few of them because, we have such a low point right now that there's going to be a few that are created over the next year or two. But I think setting expectations for most of us, we need to understand that real estate is not, this just like pot of gold for a limited partner investor, but it could be for the owner investor or the sponsor investor. But for the limited partners, I think expectations are going to be a little bit lower. There should be. So
just to clarify a couple of things. So an IRR is just an internal rate of return. And the reason that we use that in real estate rather than just saying ROI, which is return on investment, is because you get paid in different buckets as an investor in real estate. And this is true if it's a 240 unit apartment building or you put it in an ADU unit next to your house that has rental income. So when you think about that internal rate of return, it's first your cash on cash return. So if I put out $100,000, how much cash flow am I going to make on that return? Well, if I make $9,000 a year, then I've made a 9% cash on cash return. The other way that you get paid is through amortization. So at the end of the year, you're going to look back and you're going to go, oh, I took out a mortgage on that. Let's say I took out a $100,000 mortgage. but there's only $93,000 in debt left. Well, you'd have to count that into your return as well. And then, of course, there's usually appreciation. So the value of the property is going up. So an IRR is helpful because it looks at those things and says over a 10-year time horizon, over a specific amount of time, if I take my cash flow, my amortization, and my appreciation, and we add them together, then we divide it over 10 years, what is my annualized return over that period of time? And in many instances, in year one, you may have very low returns because maybe you've got a vacancy, maybe you're investing money into it, so on and so forth. Maybe the market isn't appreciating, but over 10 years, what is my annualized return? And that's how an IRR, that's the value of an IRR. The math calculations there's calculators for.
That's a really good explanation. Yeah. So, I mean, for someone that's like buying a single asset like that and trying to calculate that, that was a really good explanation.
Did I miss anything in the calculation when you get more in larger scale?
Well, but yeah, there's just one smaller piece to that, but it's the time, speed of money. So yeah, because if you can see some super high IRRs, like I've seen stuff in the mid 20s, high 20s, but when you go look beneath the hood, you're going, oh, that's a compressed time frame. Okay, that's 16, 18 months. All right. And what that investment is, it's somebody that wants to use your money short term and they're willing to pay a return that looks like it's off the charts. But if you're putting in 100 grand and you're only getting let's say 7 grand back because the investment time frame was 6 months, versus
Got it.
yeah, you're going like, God, was that worth putting out 100 grand for 6,000? Was that risk reward? Did that really do? You're going like, hell no,
Yeah.
for most
Yeah.
people.
Yeah. I usually look at my IRRs when I'm doing deal analysis over 10 years. Is that what you normally do, just out of curiosity?
Yeah, no, absolutely. But I think anything past 7 is you're flipping a coin. 10, we don't go past 10 at all. Yeah,
Yeah.
never.
Okay, great.
That's very accurate.
Very good. That was super, super helpful. Okay. I want to ask you one question before my last question.
Okay.
Tell me how you think about inflation. And how does inflation impact your investment decisions?
Man, you picked the right guy for this topic, I tell you.
All right, let's geek out on inflation. This is my jam.
Oh my gosh. I you know, the inflation is 2x to 3x what we're being told. Okay. So, it just, I see it because probably you and I look at money every day in some form or fashion. Money's, we analyze it. How can we protect it? How can we let it serve us? There's so many things we look at. It's just, it's a benchmark in our lives. So, I think inflation is here to stay. Okay. You talked about the valuations of dollars, real estate going up, the dollars going down when you sell something, great example, on that. The inflation component of this is, you need to be prepared to understand that at a minimum, I think inflation at a minimum is going to be 4 or 5% just based off the debt that we have and how we track inflation. I think the overall inflation right now is probably closer to 10%, even though we're talking 3, and that's why I said, 2 or 3x on this. It's not going anywhere. It's here to stay, and it's been with us for decades and decades, probably since the 40s and 50s on this. So, and I look at, you take a piece of real estate and you look at it and you're going, the value of the dollar continues to go down. Well, all in all, what you're paying for a house, even though the price of the house keeps going up, it's because the valuation of the dollar keeps coming down. So are you really netting?
That's it.
Are you really making that much more? If you take that money that you sold your house at, but you have to use 2x money to buy your next house. So that's why when you talked about holding, assets longer term, that's how you help yourself with inflation, because being able to do a refi and pull cash out and hold that asset and let that asset work for you is powerful stuff, really powerful stuff. So, my take on it is, you need to build it into your everyday life and understand. Now, I'm help. I'm one of the probably crazy loons that you've had on here. You know, I bought into
I'm pretty crazy, Darin. I don't know.
I bought I bought into Bitcoin stored value. I mean, I think I believe, and I no, I think I understand it. I'm pretty sure I believe in it. And I just keep going. Something is about to happen, you know, and it's just part of it's a small piece of what I do, but I just couldn't, you know, kick it out the door. I had to pull it in. I had to understand it. I had to think about it, learn it. But that's one of the hedges that I'm preparing for even more inflation. It may work, it may not, but real estate, hard assets, metals, Bitcoin, I think all of that needs to be in your portfolio at whatever level you're comfortable with.
Well said. Because we're chart nerds together, I want to show you a couple of charts that I think are really powerful to back up what you just said. And also, you may want to use them in one of your blogs. You may find it interesting. So, this is cumulative inflation going back to 1913, which is when the Fed was created. And from 1913, let's just call it to 1970, let's just round it and say over that 60-year period of time, you had 284% cumulative inflation, which means that, you know, about every 20 years, the cost of things doubled. But think about that. If a 5-cent piece of bubble gum costs 10 cents 20 years later, that's a reasonable amount of inflation. You could survive on that. But what happened from 1971 going forward, which is when we left, you know, the gold window was closed, Nixon closed the gold window, and we became a true fiat currency from 1970 through 2022. So that's 50 years. So a shorter period of time, we saw 2,639% cumulative inflation over that period of time. And that just is the value or the purchasing power of the dollar absolutely cratering. I want to show you one other thing that I think you'll really connect with here. So this is U.S. house prices. Instead of measured in dollars, it's measured in gold, Darin. So the green line is house prices. In 1953, the median home price was 18,100. And if you come all the way to 2024, you get a median home price that is somewhere around 400,000, right? So prices up from 18,000 to 400. The blue line is the price of gold. And in 1953, the ounce of gold was $35. As you move over here to the right, now today, gold is something like 25.50. But when I did this analysis, it was like 2,400. So people would say home prices are expensive. They're too high. They can't go up forever. Home prices are expensive. But what they're missing is if you value home prices not in dollars, but in gold, home prices are down 65% because, and here's why, it took you 517 ounces of gold to buy a home in 1953. You fast forward to, let me get my slides right. You fast forward to today, over here, you only need 180 ounces of gold to buy a home. So the punchline is home prices in gold are down 65%. So it's just if measured in gold. So it's just an interesting contrast. People are saying, well, home prices are too high. Compared to what? Compared to the dollars that have had 2,600% inflation, the value of those dollars have gone to nothing. So I almost am at a point where I think if you think home prices are going to crash, then that would mean that the US dollar is going to increase in value. It's going to appreciate in value. And the way that the US government is borrowing, the way that the US government is creating quantitative easing every time we run into a recession, I can't see how that would be accurate. So I'm just curious about your take on that.
Yeah, I had not seen the gold chart like that. Yeah, I do want to use that. I do want to use that. I, you know, it is beyond sad that we have not a tax collection problem, but a spending problem at the federal level. Okay.
Yep.
And every
Yep.
time I think a new administration is going to come in and put a cap on something, or put some control, it never happens. It's just a bunch of chatter for the next, 8 or 9 months, or for 8 or 9 months, and then nothing happens. It just, that's why we need term limits. So you'll get me talking about term limits.
I could not agree with you
I
more.
just, there's just way, it's just
Yeah.
pitiful, absolutely pitiful. So, you know, I first time seeing that chart, understanding 100, was it 180 ounces versus 500 ounces, something like that.
That's right.
Yeah,
That's right.
I had not put it into that perspective at all.
I'll send you the website
Yeah,
that has these interesting graphs. They also do it where they measure houses against oil. And same thing, if you measure houses versus a barrel of oil, home prices are down. This will be a funny one, but they measure houses in terms of Bitcoin. In terms
yeah.
of Bitcoin, home prices are down 100%. Spoiler alert. So I'll send you this website because it's really fun. Your college age kids might get a kick out of it, but it's just an interesting to check ourselves and think, there's a guy named Jason Hartman, who's a really savvy single family real estate investor. And he always says the most important question is compared to what? Houses are expensive compared to what? Dollars. Okay. So is the house expensive or is the value of the dollar just gone down?
Well, so let me ask you a quick question then, okay? In your little micro bubble where you live and mine, we have two things. I think federally, one of them is pretty obvious, and then there's one locally. But what's not keeping up with housing is incomes. All right.
Right.
Yeah. So when you do a comparison to incomes, and that spread keeps getting a little further apart and further apart every year. So, if you are a home buyer or a home renter, okay, here's a number that we look at quite a bit. Our spread between the cost of ownership is in the Austin metro area is now $1,300. Okay, it costs you
More
thirteen
than the
hundred
cost of rent.
dollars more a month to own than it does
Yep.
to rent. Okay,
Yep.
that's significant when you're 25, 28, 32. I mean, that's not small money, not including that you had to go and put the down payment down. All right, 20%, I guess, is still the number today. But, you know, compared to incomes, housing is becoming incredibly expensive. So that bubble's got to break someday. I don't know what your market is as far as rents, but what's happening? Is it a renter's market? Is it a buyer's market? What does it look like where you guys are?
Well, the first thing I would answer that is to say, look at what's happening in Canada. If you look at the Canadian home price to income, it is 3 times as bad as the US's annual income to home prices. So my first answer is it can get worse. In other
Yeah.
words, the home price to income ratio can get worse. Well, how does that work? Well, people start house hacking. People start figuring out additional revenue streams from those homes. People start passing down those homes intergenerationally, where they're giving either early inheritances or giving homes to kids. So the prices going up doesn't always mean that price has to come down. You can, and that's evidenced by what's happening in Canada, that their ratio is way worse than ours. The other way I would answer that question is, all right, let's just say that my household income is $100,000 a year into my household income. Well, if my wages in that home go up 4%, that's another $4,000 a year, or another, let's just call it $350 a month in income that I have. Well, if home prices go up 10% over that year, that may only cause the mortgage payment to go up another $350 a month. So if you've got 4% increase in wages, you can keep up with about a 10% increase in home price if the interest rate stays the same. If the interest rate stays the same. So because not all of your income goes to your mortgage, right? You're only going to use whatever it is, 30 or 40% of your income to go to your mortgage. So I think that sometimes that the mainstream media will say, hey, home prices are going up at 10%, wages are going up at only at 4%. Yeah, but a 10% increase in the home price may only equal 4% increase in their wages. So that's another thing that I think the mainstream media gets wrong. Um, I think that it is a risk factor. I absolutely do think it is a headwind. Like we go back to headwinds and tailwinds, it's a headwind for the market. But the tailwind for the market is our demographics. So, our millennials are the biggest cohort generationally that are becoming homebuyer age since the baby boomers. At the same time, after 2006, the number of homes being built went way, 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 way down. And we've not caught up. There's more demand from millennials than there is homes being built still to this day. And it's been true all the way back to 2010. So we've got this major supply imbalance where there's more demand from millennials than there is supply being brought to the market. And that tailwind is overcoming the headwind of the lack of affordability that you've talked about. Now, this year and really last year, it kind of hit like the headwinds and tailwinds kind of had a stalemate because you hit 8% mortgage rates or thereabout, high 7, and you hit all-time high home prices, and you had inflation robbing dollars out of the bank accounts of so many of these buyers. And so you kind of hit this standstill in markets like Austin and some areas in others in Texas and Florida. You saw prices come down, but nationally, you're still seeing housing prices at an all-time high, according to Case-Shiller. So the way I see it is as mortgage rates go down and that housing becomes more affordable, that's another tailwind pushing the housing market forward. And I believe between lower mortgage rates and this huge amount of demographics of millennials that want to own homes, I believe that that'll be a stronger force than the headwinds of the lack of affordability.
Yeah, I think we're going to start seeing a slow shift.
Yes.
I think so for sure. And I'm just real curious, and I'm curious to myself, not an open-ended question here, because I know we're kind of towards the tail end of this of our podcast, but I'm wondering how many people are going to choose the nomad lifestyle of renting and flexibility. Because I look back at my own youth, it was a rite of passage. We talked about rite of passage. It was a rite of passage to own a home. You were a big deal, okay, if you could buy a home, and it got you into the community. It got you at a different level in the country club, blah, 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 all that stuff. I don't know that that's still the way it is. I just don't know.
Well, if it was me, I would just travel. I would be a nomad, like exactly what you're describing.
I'm
But
ready.
but luckily for me, my wife is my better half, and I'll tell you what, that whole living downtown, we lived in a condo, the whole thing, where the rubber meets the road for I think that most people, a lot of people, is when they start to have kids.
Yeah.
And when you start to have kids, you start to have different considerations. Like the nomad thing is all about adventure and experiences and cool food. But when you start to have kids, you start to think about like, you know what? I really want my neighbors to be able to come over and watch my kids when I'm out. When the kids are running out on the street, I want to know everybody and I want to know they're invested in community. And all of a sudden, safety and community become more valuable than experiences for a period of years. And that's where the millennials are right now. They're at that kid age. They're at that we need to have roots and community to take care of our kids. And then when the kids move out, then you can go back to the nomad thing. So that's my take on it.
No, that's fair. It seems like to me that people are pushing that first home acquisition. They pushed it, yeah, to mid 30s now, not
Yes.
not
Yes.
late 20s. Yeah. So, a 7 or 8 year push, and is that going to get pushed? And everything's getting pushed. We're living longer. We're healthier. We have more experiences when we're younger because we can now. We didn't have couldn't afford to get on a plane when I was growing up. I didn't, those type of things. But no, it's just going to be interesting to see how home prices, how they fare, even though we have a kind of $400,000, $600,000 deficit in homes.
Yep.
You know, I mean, so it's huge. So
Yep.
anyway, I'm just pondering and going off. So I apologize. So
Hey, that's what these podcasts are for. We're having fun and sharing ideas. Hey, tell us, Darin, where can people find you as it relates to what you're doing at Club Capital and Presario Ventures? And if they want to invest alongside you or learn more from you, what's the best way for them to get a hold of you?
well, who do we know that I'm going to put something up here for you. You may know this if he still does this. Remember Carl Rove when he would
Yes, of course, yes.
you know, he'd put the board up there and do all this stuff. Yeah. That's clubcapital.co. Yeah. I love it when he would like put all his charts up and doing all this stuff. That's
Who
old
who
school. I
who
like
was
that.
the old? Oh my gosh, I could see his face, but I can't think of his name. The old Ross Perot.
Yeah.
That when he would run for president, do you remember he used to have those white pieces of paper and he'd write on the pieces of
Oh yeah.
paper?
He's
I
up there
remember
on his flip charts. Yeah. He
the
was
flip
going.
charts. Yeah, that was great.
I remember his that was what the late 90s when he was running for president and he's the reason Bush Senior didn't get put back in the White House. So
Right.
anyway, yeah, no, clubcapital.co. And we have lots of content on there just about the common equity, pref equity, apartments, supply, demand, demographic. I mean, it's a bunch of educational stuff.
It's great.
It's on there and pretty easy to get to clubcapital.co.
Wonderful. And they can reach out to you there as well.
Yeah, in fact, I have my cell number on the website. But it's my email's on there. I mean, my cell's on 24/7 just because we're very customer centric. If somebody wants to talk, I talk. But I'm a good one more time, 567-2600. That's area code 512-567-2600. So
Great. Well,
yeah.
Darin, thank you so much. I just jumped on your blog and saw everything under the education headline. There's a ton of stuff in there.
Yeah.
It's been a pleasure to spend time with you, my friend. Thank you very much for joining our podcast, and we hope you'll join us again in the future.
Gosh, enjoyed it. It was very entertaining. We both I think we were